Now, one of the biggest mistakes that I made early on in my real estate career is that I got really good at making money, but I didn't know how to tax plan. Meaning, I didn't keep up with tax laws. I didn't keep up with what's going to change this year, what can benefit me going into next year. So, one of the commitments that I made is that from that point forward, I started tax planning. I started understanding taxes a little bit more. And I started learning some of the things that might affect my business, but also my client's business. So, hi everybody. This is Luiz Morales. Welcome back to the Morales Group Show. This is episode number 62. Today we've got a return guest. His name is Andrew Kiefer. He works for an accounting firm called CBiz. He's actually my accountant. Today's topic is going to be about some of the proposed changes that are happening right now in regards to 1031 exchanges, inheritance tax, capital gain taxes, and there was one more.
Bonus depreciation was the other potential change.
Bonus depreciation. So welcome to the show. Now, before we get started, I want to encourage people, if you've enjoyed our content in the past and want to share this with more people, if you would hit that share button, smash that subscribe button, and smash that like button, that would help out the YouTube algorithm substantially. Welcome to the show, Andrew. How are you?
Hi, Jose Luis. Thanks for having me again today. I'm doing pretty good today. Now the tax season is over, so it's a lot better.
So I got an email from you, Andrew, maybe like 3 weeks ago, or maybe like a month ago. And basically you made me aware of some proposed changes that might be going through in 2022. Now, one of the biggest mistakes that I made early on in my real estate career is that I got really good at making money, but I didn't know how to tax plan. Meaning, I didn't keep up with tax laws. I didn't keep up with what's going to change this year, what can benefit me going into next year. So one of the commitments that I made is that from that point forward, I started tax planning. I started understanding taxes a little bit more, and I started learning some of the things that might affect my business, but also my client's business. So some of these changes are real estate specific. For example, like the 1031 exchange. Can you elaborate on some of the proposed changes for real estate agents, real estate investors, and people who own real estate that are potentially going to change in 2022?
Yeah, so everything we're going to cover today is like you said, potential changes. This has been talked about. We've had coronavirus stimulus packages come out both under President Trump and President Biden. President Biden has proposed a large infrastructure spending package. So there are going to need to be ways to pay for this spend that the federal government is doing. So what we're going to cover today has been talked about by perhaps President Biden or members of Congress on the Democratic side of ways to raise money. So none of these are in place yet. They could substantially change between now and what finally gets enacted. But it's good to at least be aware of what some of the potentials are out there that people can just be aware of. We are in a time of historical low tax rates. There is only one direction for tax rates to go, and that is up. And so maybe not all of these get passed, maybe only pieces of them do, but odds are something is going to happen here within the next, I'd say probably by the end of the year, we'll have more clarity on this and perhaps something actually passing through Congress and getting signed into law. So one of the first big ones that you mentioned that we want to talk about is 1031 exchanges.
Yeah.
So just to kind of step back on what a Section 1031 exchange is that is available to people who own real estate. They are able to sell that real estate and purchase a replacement property, another piece of real estate for investment purposes, and defer the gain on the sale of that original piece of property that they held. So for example, let's say I purchased the house for, let's say, $250,000. It is now worth $400,000. If I were to sell that, I would have to pay tax on $150,000 of gain. If I instead do a 1031 exchange, what I do is sell that property, making sure that I qualify for all the parameters of Section 1231, and buy a replacement property. So I buy another residential real estate property to rent out. I buy another apartment building to rent out, something like that. If I'm able to do that, I take that $150,000 gain that I have and I defer it into the purchase price of my new property. So people can consistently do these 1031 exchanges to push off paying taxes for years and years and years.
Mm-hmm.
So one proposal out there is the potential elimination of this 1031 exchange. And so that would mean even if I sell my original house, my original investment property, and replace it with another property, I'm still going to have to pay tax on that $150,000. So I, as an investor, am not going to have as much money available to me to go out and buy my replacement property.
Mm-hmm.
So that is one of the proposals that is out there. I've heard varying things on this 1031 exchange. One is the complete elimination of a 1031 exchange. It's not even allowed anymore at all.
Mm-hmm.
Another proposal that I've heard is potentially limiting it to you can only defer a certain amount of gain into your next property. Or the third way I've heard that this might come out is if your income is below a certain threshold, you'll still be able to do a 1031 exchange. The problem with that last one, though, is a lot of times when you sell a property, you have a gain. That gain is probably going to push you above whatever threshold there is, and so the 1031 won't be available to you. But it is something that has been proposed out there to at least tweak, if not eliminate, the 1031 exchanges.
Perfect. So for the viewers out there watching, the reason Andrew sent me this article is I did a couple 1031 exchanges last year, and he basically, in his message to me, said, Jose Luis, might want to read this article. If you're considering doing a 1031 exchange, another one this year, it may be better to do it this year versus holding off until 2022, because if this goes into effect, and obviously we don't know if they'll make it retroactive, but it would essentially change some people's game plan. So my advice to consumers is if you're considering doing a 1031, if you've got a property where you're considering doing a 1031 exchange, it might be a serious consideration for you to do it sooner versus wait until something potentially happens. Now, Andrew, on this particular one, are there any talks that they can make it retroactive, like meaning like make it effective? I don't think that would be fair at all if they did something like that. But is there any chance that that could happen at all, or would it likely come into effect in 2022 if it's something like this did go through?
When they pass tax law, they can make it effective at any point in time.
Okay.
Generally, things like this are prospectively. So what I'm reading now is if we do get any of these tax law changes, and most of them that we'll talk about today, they would most likely be effective January 1st, 2022.
Okay.
Like I said, there is a chance they could change their mind, and as soon as it gets signed into law, it could go into effect at that point in time. Okay. But I wanted to echo exactly what you said before about if anybody's thinking about doing a 1031 exchange, now you probably need to think about it a little harder. I know a lot of people, real estate investors, they buy and hold on to the property for a long time. They like to get the passive income from rent checks coming in every month. And those are probably the people that aren't going to be too impacted by this, at least immediately. Uh-huh. But for investors who are looking to start off with a starter home and eventually sell that and move into bigger properties, the next 7 months, 6.5 months here is probably a time to be thinking about, is this the type of property I want to be in long term? Is now a good time to potentially go out and seek another property?
Well, I'll tell you this, Andrew. For example, I have a customer that owns a property in Camarillo. She lives in Marina del Rey. She wants to exchange into a property in Marina del Rey, mainly to just have the asset closer to her and to make it easier to manage versus having to drive out to Camarillo. So in her instance, it would make sense to consider doing something this year versus maybe waiting off in case they eliminate it. Now, the other thing I wanted to talk about is what about the inheritance tax? So I know that that plays an effect as well too. What is that? What are some of the proposed changes that are potentially going to happen, and what can somebody do to kind of plan ahead in that department?
Yeah, so another big change that they're looking at is changes to inheritance taxes. Uh-huh. And so normally what happens is when someone passes away if their estate, so if all of the assets that that person owns are above a certain dollar threshold, the estate pays tax on that before it gets passed on to the heirs. So if I were to die, if I accumulated real estate, stocks, if I own a business, collectibles, artwork, whatever it happens to be, and that is all worth over a certain dollar amount, my estate's going to pay tax. Right now, that amount for the estate tax is $11.7 million per person. So if I were to die today with $11 million of assets, my heirs can inherit it with no, I'm not going to have to pay any estate tax. They're going to just inherit it, no big deal. And that $11.7 million is per person. So for a couple, you're looking at over $23 million. That limit is set to sunset back to $5 million per person in 2025. So we know we're getting a change there no matter what.
Per person.
Per person, right. So yeah, so a married couple would be $10 million, and then there's some inflation adjustments that they would need to do to that too. So let's say that I have assets now that are worth $10 million and I'm single, I'm not married. I die today, no big deal. If I die in 2026, my estate is going to have to pay inheritance tax on $5 million worth of assets. I get $5 million free, and then they pay tax on another $5 million. So the first change that's potentially out there is lowering that threshold to potentially $3.5 million, maybe even $1 million. I mean, when I started my career in accounting, that limit was less than $1 million that you could pass on tax-free. So we know we're going to $5 million in 2025. Like I said, the proposals out there are to get it down to less than that sooner than 2025. The other curveball that could be in here too is right now the inheritance tax is a flat 40% tax rate. There's talk about increasing the tax rates on that to 45%, and there's even a proposal for a tiered structure that gets up to a 65% inheritance tax on estates over $1 billion. So we hope we all have that problem one day, but I mean, that's another way that they're looking to increase the taxes. So that's one piece of it, is the actual tax that my estate would have to pay. The other side of that, of the equation when it comes to inheritance tax, is what's called step up. So that's when, that's the other piece of it. So like I said, if I die today, and I'll just use $5 million because that'll just be an easy number to go with, and that's all held in an apartment building that I happen to own. That's my only asset. Well, I bought that asset 20 years ago for $1 million, and it's appreciated in value now to $5 million. So if I were to pass away and pass that apartment building on to my heirs, they would inherit what's called a step-up basis. So their basis in that property would be $5 million, the fair market value when I died. And that theoretically means that they could turn around the next day, sell that property for $5 million and not pay any federal or state taxes on that. Well, there's a proposal now with the changes to inheritance tax to eliminate that step up in value. So my heirs would inherit that property at my basis. And so if they were to turn around and sell it the next day, they would pay tax on the gain on that property. So it's kind of a double whammy where you could be hit with, I mean, now we're talking, let's say we have a $5 million inheritance limit and that building's worth $10 million. Well, my estate's going to pay 40% tax on a portion of that value increase as an inheritance tax. And then if my children wanted to sell that property, they're going to have to pay capital gains tax on that again. So it's a double whammy way to raise taxes. This elimination of the step up in value has been proposed before. It's been struck down because it's very complex to try and track that, especially in a multi-generational situation where it passes on. Say it went from me to my kids and then to their kids. Tracking that basis over potentially decades would be difficult. But then again, I think it's just hard to see the same asset being taxed twice. So who knows what's going to happen there? But it could be some combination of a lower limit on estate tax coupled with this elimination of the step up, and that's really going to impact people who inherit property. I
Yeah.
mean, a lot of times people will invest in real estate and they'll never hit those magic limits of paying estate tax, but they want to pass these assets on to their children
Mhm.
without a huge tax burden. And I mean, that could potentially completely disappear if we don't get a step up, especially with the potential elimination of 1031 exchanges. I mean, a good tax strategy and a long-term tax strategy is buy real estate, do a 1031 exchange it into another property, defer the gain. Take that property, buy another one or two pieces of property, defer that gain. I keep deferring gains until I die. If I'm less than that estate tax threshold, my heirs inherit all that with no tax implications. That could all go away now. So we could see a lot of older real estate investors have their estate plans getting, let's say, throw a curveball at their estate plans.
Yeah.
And what they wanted to do and what they wanted to pass on to their children might not be what was originally in the works when it all started.
So if this goes through, in other words, probably the best advice that we can give the viewers is to be in communication with your attorney, with your estate planning attorney, because it may make sense to maybe can you gift properties during your lifetime to reduce the amount that you pass on when you die? Is that one of the strategies that you can use, or what would some of the strategies that maybe like an estate planning attorney would implement? And maybe that's a different conversation with them, but it would probably be wise for them to if they're in that limit of the $5 to $10 million estate, it would probably be wise to talk to their attorney, right?
Right, and like you mentioned, gift taxes, and that was something I was going to bring up too. Was right now the estate tax and the gift tax are coupled to each other. So you get $11.7 million to give away while you're alive or when you pass away.
Okay.
So theoretically, I could give my assets away now, get down to zero, and pass that on. And that might not be a bad idea if I'm going to pass on real estate and appreciating asset. If I can give it to my children now and it's worth $2 million, but in 20 years from now it's going to be worth $4 million, I only get dinged on my estate and gift tax limitation for $2 million. So right now those two numbers are coupled to each other, so they're the same. Part of this proposal for the change in estate tax is to potentially break that that limitation, and that the one proposal that's probably the more likely one that's being pushed is to have a $3.5 million estate tax, but only a $1 million gift tax. So I can only give away $1 million worth of assets while I'm alive, and then pass on that remaining $2.5 million when I pass away. So breaking that can change estate tax planning also, because like you brought up right now, you could give away assets now and kind of take away some of this and eliminate that future appreciation. But if they are able to break those limits, that will eliminate one of those estate planning techniques to get rid of assets while somebody is still alive.
So a good conversation for our viewers would be to talk to your estate planning attorney, and maybe the strategy that you guys have in place right now may change completely, and you guys may have to make some changes. But what Andrew's talking about is that if you think like the asset's going to continue to appreciate, why wait until it appreciates 400, a million, $3 million more, if things like this could potentially change? So there's actions that the consumers can take. Our job is just to make you guys aware of them and then kind of guide you to the right professionals. You're right. A very common strategy is people keep exchanging. Then they pass away. They give it to their heirs. The inheritance tax is so high right now that it doesn't affect most people. But if that gets dropped, it might affect a little bit more people. And now there's inheritance tax. So a lot of times the estates are asset rich but cash poor. So they would have to sell some of the assets in order to be able to pay those taxes. Otherwise, they won't have the liquid cash to be able to do so. So it would potentially prohibit families that want to pass assets on to their kids, from their kids actually being able to enjoy those assets and may be forced to sell them. So it would eliminate assets that are being held in the family for generations after generations. It would reduce the chances of that happening, unless you can tax plan, save up enough cash to pay for that inheritance tax, or even pay for the other tax as well.
Yeah, I mean, I went through a perfect example of that. This is when the estate tax limits were a lot lower, probably in the $3 million range. But that happened to one of our clients, where their assets pretty much consisted of a business and a home in Newport Beach that they bought on the beach, probably in the 1950s.
Yeah.
And they really wanted that to stay in the family. Well, they have real estate, which is a non-liquid asset, and a business, which, of course, this happened in 07 and 08. And so the business got impacted and wasn't worth anything, or wasn't worth as much. And so they had trouble coming up with the cash in order to pay the estate tax on this. Eventually, I mean, I think it just got wrapped up last year or the year before. So, I mean, that's about a 10-year process to pay off the estate tax in this situation. So it's something else to consider. And like you brought up too, I mean, with $11 million of estate taxes right now, a lot of people haven't really thought of this.
Yeah.
But if the amounts go down, and especially, I mean, you think in California, you own a few pieces of real estate, you maybe hold them for the next 20 years, you could easily surpass $3.5 million.
Yeah, agreed, 100%. So it makes it so that, like, something happens to somebody that you love, like a family member who's supposed to leave you this property. Now you've got this huge tax burden, and you've got no option but to sell the property, even if you wanted to keep it. So just something for the viewers to be aware of. If you need a good estate planning attorney, I've got a couple of them that I can refer to you. If you've already got one, it might be wise to revisit that conversation.
Yeah, it's probably not a bad idea to get in touch with them before the end of the year.
Right. Yeah, because once this goes through, they might even get busier. And and
it might be too late at that point too.
Really? What do you mean by that?
Well, I mean, if the law goes into effect and takes effect January 1st, 2022, I mean, if you try and do anything in 2022, you're under the new law. And so if we're able to get this postponed until January 1st of 2022 and take effect of the existing law that we have now, you might be able to get lower tax rates, higher gift limits, that type of stuff.
You might be able to gift away some of the properties as well too. That is a great point, Andrew. I actually didn't think about that, but that is a great point. So yeah, it would be in your best interest to reach out to them sooner. The other thing, and this is something that I've done on some properties. Obviously, I've done some bonus depreciation on some of the properties that I own. What is the story there? Is that here to stay? Is that one of the proposed changes as well too? And who does that affect?
Yeah, so bonus depreciation. So when you buy an asset, something that lasts more than a year, the government generally doesn't allow you to write off the full value of that immediately. You have to depreciate it over time. Mm-hmm. For example, if you buy a residential real estate property, that the government says that has to be depreciated over 27 and a half years. Mm-hmm. Commercial real estate property, it has to be depreciated over 39 years. So bonus depreciation doesn't apply to real estate, the actual physical real property. It applies to like the tangible property. So think certain vehicles, computers, furniture, and fixtures. If you're thinking real estate, it's the refrigerators, the dishwashers that you have to buy, that type of stuff. So there's something in the tax law now that's called bonus depreciation that allows you to write off 100% of the cost of those assets. So you get an immediate deduction when you purchase those. This is only a federal deduction. The state doesn't have an equivalent, so this is a federal thing. Mm-hmm. So right now, you're going to write off 100% of the purchase price of those assets. There's a change. When that came into effect, it was scheduled to gradually go away anyway. So it reduces from 100% now to 80% in 2023, goes to 60% in 2024, 40% in 2025, 20% in 2026, and then it gets eliminated by 2027. There's a proposal to eliminate bonus depreciation completely, potentially starting next year. So bonus depreciation is there in the tax law as a way to kind of stimulate the economy. If you know you can go out and buy a refrigerator, buy a new car, upgrade your computer system, things like that, and you know you're getting 100% deduction for it, well, that $10,000 new computer system I need to buy maybe now costs me after tax $7,000. So I'm more likely to do it. So that spurs me as a business owner or consumer to spend my money and stimulate the economy.
Yeah.
And so there's the potential, though, because you get a large tax deduction for this, to eliminate or potentially cap this large deduction. And so that's one that could potentially go away as well. It's scheduled to go away anyways, but they could accelerate that process to eliminate it sooner.
When you say cap, do you have anything more specific, like cap at a certain dollar amount, or yeah?
Yeah, I mean, potentially there's another provision out there in the tax law called Section 179 that allowed immediate expensing for certain assets too. But there are always limitations on how much assets you acquired in a certain year. If you acquired more than a threshold, you weren't eligible to take the Section 179. Bonus depreciation has kind of replaced that for now because it's a lot easier to do. But they could blend the two together and come up with some sort of limitation. Or, like I said, more likely a complete elimination of bonus depreciation. So we would still have Section 179 expensing, but that's a little more restrictive, and it does have dollar limits associated with how much you can write off in a certain year.
Perfect. Okay. And then the last one that we wanted to talk about was, I think it was the capital gain taxes. Tell us about that. How could that potentially change, and what can somebody do? And what advice could we give them in a situation like that?
Yeah, so it's not only potentially capital gains, it's potentially ordinary tax rates that could go up as well. So I'll hit the ordinary tax rates first, and then we'll get into capital gains. So right now, the maximum ordinary income tax rate is 37% on incomes for a married couple over $600,000. The proposal on that is to restore the old tax rates, which would get us back to 39.6 as a maximum federal tax rate on incomes over $400,000. So not only is the proposal out there to increase the tax rate, but it's also to lower the tax bracket so it applies to more people. So that would be one thing to consider, is just on ordinary income. So your ordinary income is your wage income, your business income, your rental income, interest income, things like that. Then the other side of that is capital gains income. So capital gains income and the income tax rate applicable to capital gains comes into play when you've held an investable asset for more than 1 year. So any investable asset is, if you buy a stock, you own your own business and you want to sell it, or in this case, real estate as well. So if you hold that property for more than a year, the gain on that is taxed somewhere between 0 and 20%, depending on your other income items. The proposal out there is to change and eliminate capital gains tax rates for what I've read right now is incomes over $1 million. So this could affect, or easily affect, a real estate investor, where say you have a job and you make, between husband and wife, you're making $300,000 in wages. You've got another $50,000 in dividends and interest income. So now you're at $350,000. Well, you sell a piece of real estate, and let's say you have an $800,000 gain on that. Well, if they eliminate 1031 exchange, I can't defer that gain, so I'm going to have to pay the tax on that. I add that gain to my other income. Now in that example, I'm at $1,150,000. I've just eliminated my capital gains on that sale of that piece of property. And now that's all going to be taxed at an ordinary income tax rate. So it's really something that people are going to need to think about when they're selling properties is, what income is this property going to generate? What other income do I have? And am I going to be pushed over this $1 million threshold? One article I was reading said that they might even drop this down to $400,000. And so, I mean, can you imagine almost every property in California that you've held for a decent amount of time is probably going to have a gain that you're not going to be able to defer under a 1031, and will probably push you with your other income items into a tax bracket of over $400,000 of income, and you're paying 40% on that. Throw on another 10% for the state, and you're looking at 50% combined tax. So I think these things will really, if people really need to consider what their plans are for real estate coming up. Is this a buy and hold situation, or is this something I was thinking about selling anyways? Because there could be the potential for a lot of taxes on these types of transactions where we didn't have to consider them before with capital gains rates. I mean, capital gains rate of 20% compared to a max ordinary rate of 39. I mean, we're doubling the federal tax on that transaction, even without a 1031 exchange. And this doesn't even bring into consideration selling stocks if you're investing in the stock market. And heaven forbid you have your own business that you've done successfully in, and you want to try and sell that business. A lot of that gain when you sell your business is capital gain too. And that's all going to be taxed at ordinary income tax rates. So I just don't know what's going to happen here in the future, but there are a lot of potential increases in tax rates potentially on the horizon here.
Yeah, absolutely. Okay, great. Well, this has been obviously extremely helpful. Obviously, we touched on some topics that a lot of people were not thinking about, but it's something that you should think about at this present moment. Is there anything, Andrew, that we missed or anything else that you think would be valuable for the viewers?
No, I think we hit all of the big ones. I mean, there are a number of other proposals out there. Potential increases to corporate tax rates going from 21 to 28%. Changes with businesses that operate in foreign jurisdictions, what the taxes are there. Other potential changes to estate planning techniques that we didn't even get into. So there are a lot of proposals out there. I would just suggest that people keep their ear to the ground. Just Google President Biden's proposed tax changes. Maybe do that once a month. If you're not hearing it in the news, you can kind of see what's being talked about out there in the general consensus. But I expect something to happen towards the end of the summer, beginning of the fall. We'll probably get more steam behind this and get a little more concrete proposals of here's exactly what we're proposing, rather than, oh, we think we're going to do this, or one campus proposed this and another campus proposed that. But it's something to pay attention to between now and the end of the year.
Perfect. Great. So I want to encourage the viewers, if you found value in this episode, make sure to share the episode, subscribe, and like it. Andrew, thanks again for being on the show. Obviously, as always, you provided a lot of value. Where can people find you if they like your advice and maybe they want to get a hold of you?
Yeah, thanks. Yeah, so the name of my firm is CBiz, C-B-I-Z. My office is located in Oxnard, California. Phone number is 805-988-3222, or my email address is akiefer@cbiz.com. That's akiefer@cbiz.com. And thank you very much for having me today, Jose Luis.
Likewise, this was episode number 62 of the Morales Group Show. We talked about inheritance tax. We talked about capital gains. We talked about 1031 exchange. And we talked about some of the proposed changes that are happening and gave people some advice as to how to approach this. Make it a great day. And thank you, everybody, for tuning in.
Thanks.